Welcome back, students and scholars. In the previous class of ASC 205, we discussed discontinued operations, where a major business exit gets separate presentation. Today we move one level deeper into financial statement seriousness. ASC 205-30, liquidation basis of accounting. This is the point where normal reporting no longer fits because the entity is not being viewed as a normal ongoing business. The words may sound heavy, but do not worry. We will keep it clean, practical, and memorable. Liquidation imminent, expected realization, disposal costs, and liquidation statements. Let's start with the biggest misunderstanding. A struggling company is not automatically a liquidating company. Weak profits, cash pressure, covenant trouble, and even going concern doubt are serious, but they do not automatically change the basis of accounting. A company may be under pressure and still prepare financial statements using normal going concern reporting, with proper disclosure where needed. Liquidation basis begins only when liquidation is genuinely imminent. So the first memory rule is simple. Financial trouble is a warning signal, not the trigger itself. Here is our learning path for today. First, we will place ASC 205-30 inside the ASC 205 family. Then we will identify when liquidation is considered imminent. After that, we will see how measurement changes when the reporting objective moves from operation to realization. Then we will discuss the required liquidation statements. Finally, we will look at common mistakes that students and professionals can easily make. This class is not about making liquidation scary. It is about making the reporting logic precise. Let us connect this to the full ASC 205 map. ASC 205-10 protects comparability across periods. ASC 205-20 separates major business exits through discontinued operations. ASC 205-30, today's topic, applies when liquidation becomes imminent and the reporting basis itself changes. ASC 205-40, our next video, deals with going concern doubt and disclosure. So ASC 205-30 is not just another presentation note. It is the point where the going concern assumption is no longer the right foundation for the financial statements. Now we come to the trigger. Liquidation basis is required only when liquidation is imminent. That means the path is effectively set. A plan for liquidation may have been formally approved by the right authority and the chance of blockage or return is remote. Or liquidation may be imposed by external forces such as legal or regulatory action, and return to normal operations is remote. Notice the discipline here. This is not about management anxiety, market pressure, or bad quarterly results. The basis changes only when the liquidation threshold is actually crossed. There are two paths to imminent liquidation. The first is a voluntary approved plan, where the governing body, such as the board, formally approves winding down the entity and the likelihood of being blocked is remote. The second is imposed liquidation, where management may not choose the wind down, but a court, regulator, or other external force pushes the entity into liquidation. Both paths lead to the same accounting conclusion. The source of the decision may differ, but once liquidation is imminent, the reporting foundation becomes liquidation basis. So what actually changes in reporting? Under normal basis, financial statements assume the entity continues operations. Assets, liabilities, revenue and expenses are reported under the ordinary going concern model. Under liquidation basis, the question changes completely. Users are no longer asking, how is this business performing? They are asking, what amount is expected to remain after assets are realized and obligations are settled? That is a major conceptual shift. Liquidation basis is not a slightly revised balance sheet. It is a different reporting objective. Asset measurement under liquidation basis focuses on expected collection or sale amount. Receivables are measured based on what the entity realistically expects to collect. Physical assets are measured based on expected disposal amounts in the liquidation context. And here is a very important point. Expected realization is not always fair value. Fair value often assumes an orderly market transaction. Liquidation may involve time pressure, a limited buyer pool, or distressed conditions. So do not casually replace expected realization with fair value. That shortcut can create a wrong answer. Liabilities do not disappear just because liquidation has started. That may sound obvious, but it is a common mental trap. The entity still recognizes obligations using relevant US GAAP guidance, and management cannot assume legal release from debt unless there is an actual settlement, discharge, or formal release. Liquidation basis changes how the reporting story is told, but it does not give the company permission to pretend that creditors no longer exist. Until an obligation is legally extinguished or settled, it remains part of the liquidation picture. Liquidation reporting also includes expected disposal costs and future activity. Once liquidation becomes imminent, expected costs to sell assets, wind down contracts, terminate arrangements, and complete the process must be considered when they can be reasonably estimated. Expected income or cost through the liquidation period may also be recognized when there is a reasonable basis. And very importantly, these estimates are not frozen forever. Each reporting date requires remeasurement. Liquidation accounting is not a one-time guess. It is updated as the wind down facts develop. ASC 205-30 requires two core statements. The first is the statement of net assets in liquidation, which shows assets at expected realization amounts, liabilities, and the resulting net assets available for distribution. Think of it as the liquidation basis equivalent of a balance sheet, but with a different objective. The second is the statement of changes in net assets in liquidation, which shows how those net assets changed during the period. Also remember prospective application. Liquidation basis starts from the date liquidation becomes imminent. Prior periods are not rewritten as if liquidation had always existed. Let us use the mini schedule. Expected asset proceeds are 1,200, recognized liabilities are 760, estimated disposal costs are 90. That leaves net assets in liquidation of 350. The point is not to memorize these numbers. The point is to understand the structure. We begin with expected realization, subtract obligations, subtract wind down costs, and arrive at expected distribution capacity. This is not book value storytelling. It is not a fair value parade either. It is a realistic liquidation view of what may remain for claimants. Now let's protect ourselves from common mistakes. Mistake 1. Using liquidation basis too early, just because the company is struggling. Mistake 2. Treating expected realization as automatically equal to fair value. Mistake 3. Ignoring disposal costs which can overstate net assets available for distribution. Mistake 4. Forgetting remeasurement as if the first estimate is sacred forever. In real accounting, facts move. Asset sale estimates change. Liability settlements change. Wind down costs change. Liquidation basis must reflect those changes at each reporting date. Let us log the memory card. Liquidation basis is trigger-driven reporting. Start only when liquidation is imminent. Measure assets at expected realization. Recognize liabilities and disposal costs. Prepare the statement of net assets in liquidation and the statement of changes in net assets in liquidation. And please remember the strongest line from this video. Do not confuse distress with liquidation. Financial difficulty is a symptom. Imminent liquidation is a defined threshold. That distinction is the heart of ASC 205-30. In the next video, we will study ASC 205-40, Going Concern Judgment and Disclosures. That topic usually comes before liquidation basis in the life of a troubled company because management may need to evaluate substantial doubt even before liquidation becomes imminent. We will discuss the one-year assessment, management plans, and disclosure outcomes. If this class helped you understand liquidation basis without panic, please like the video, share it with your colleagues, and subscribe to Commerce Regiment. See you in the next class where we evaluate survival doubt before the reporting story reaches liquidation.